Why numbers alone do not tell the full picture. A buyer lens for evaluating businesses beyond revenue, EBITDA, and multiples. The numbers may tell you what happened. They do not always tell you why it happened. Prepared for acquisition education, buyer discipline and strategic deal analysis. Confidential and proprietary. Anpota Incorporated proprietary acquisition research. Why numbers alone do not tell the full picture. Core thesis: a business is not merely a spreadsheet. It is a living system of people, process, reputation, contracts, customers, culture, risk, and future operating capacity. This paper is written from the perspective of Fox and Anpota Incorporated for educational and strategic deal analysis purposes. It is designed to help buyers move beyond surface-level multiple analysis and develop a richer lens for underwriting acquisition opportunities. The goal is not to dismiss financial analysis. The goal is to elevate it. Numbers matter, but numbers must be interpreted in context. The best buyers understand both the financial statement and the operating reality behind it. Inside this white paper, why spreadsheet-only acquisition analysis can lead buyers into avoidable risk. How two companies with the same revenue and EBITDA can deserve very different valuations. How private equity firms, family offices, independent sponsors, strategic buyers, and individual buyers evaluate the same deal differently. How individual buyers can gain an edge against larger capital providers. A practical diligence framework for seeing what the numbers do not show. Confidential and proprietary. Anpota Incorporated. Not legal, tax, accounting, investment, or financial advice. Anpota Incorporated proprietary acquisition research. Why numbers alone do not tell the full picture. 1. The acquisition landscape is more competitive than ever. For many people, the world of acquisitions is a new frontier. It is exciting, competitive, and full of opportunity. It is also filled with a wide variety of buyer types competing for the same deals: individual buyers, private equity firms, family offices, independent sponsors, corporate buyers, search funds, lenders, strategic operators, and investor groups. Because the market is competitive, many buyers are taught to move quickly through a simple process: review the financials, calculate EBITDA or SDE, compare the multiple to the industry, and decide whether the deal is attractive. That approach is useful, but incomplete. A multiple can help you compare transactions. EBITDA can help you estimate debt capacity and valuation. Revenue can help you assess scale. But none of those metrics, standing alone, tells you the complete truth about the business. The numbers may tell you what happened. They do not always tell you why it happened, whether it is repeatable or what breaks after closing. That is where most buyers get stuck. They become fluent in financial outputs, but they are not yet fluent in business quality. They know how to calculate a multiple, but they do not yet know how to judge the durability of earnings, the strength of the management team, the true customer relationships, the hidden liabilities, or the operational risks sitting behind the numbers. 2. The numbers are a starting point, not the whole story. Numbers are important. A serious buyer must understand revenue, gross margin, EBITDA, SDE, operating expenses, working capital, debt service, CAPEX, customer concentration, seasonality, and cash conversion. But the financials are the beginning of the investigation, not the conclusion. A business is more than its income statement. It is the combination of its people, systems, customers, assets, contracts, reputation, supplier relationships, processes, legal posture, leadership team, and ability to continue operating without the seller. A buyer who only reviews the numbers may miss the real reason the business is performing well. A buyer who only reviews the multiple may miss why the business is cheap. A buyer who only reviews EBITDA may miss the working capital stress required to produce that EBITDA. The deeper question is not merely, what did the business earn? The deeper question is, how did the business earn it? Who is responsible for producing it? How durable is it? What risks are attached to it? And what happens when ownership changes? confidential and proprietary, Anpota, Incorporated. Not legal, tax, accounting, investment, or financial advice. Anpota, Incorporated proprietary acquisition research. Why numbers alone do not tell the full picture. A lower multiple is not always a bargain. Sometimes it is the market warning you that the risk is higher than the headline EBITDA suggests. 3. Two companies can have the same numbers and be completely different deals. Consider a simplified manufacturing example. Company A and Company B appear nearly identical at first glance. Metric. Company A, Company B, revenue, $5.0 million. EBITDA, $2.0 million. Purchase price, $5.0 million. $6.0 million. Headline multiple, 2.5x EBITDA, 3.0x EBITDA. At first glance, Company A appears to be the better deal. Same revenue, same EBITDA, lower purchase price. But real acquisition analysis begins after the first glance. Once diligence begins, the picture changes. Company A has only been operating for 3 years. Company B has been in business for 35 years. Company A does not own its facility, intellectual property, or brands. Company B owns its plant, tooling, IP, brand, and customer relationships. Company A has pending litigation. Company B has no material litigation history. Company A is heavily owner-operated. Company B has a management team that runs the company without the founder being present every day. Company A has weak customer reviews. Company B has thousands of satisfied customers and a trusted reputation. Quality factor. Company A, Company B. Why it matters. Operating history. 3 years. 35 years. Longer history may indicate durability across cycles. Facilities/assets. Does not own facility. Owns plant, tooling, and production infrastructure. Asset ownership can improve resilience and collateral value. IP/brand. No meaningful IP. Owns IP, brand, and proprietary production know-how. Defensible value can justify a premium. Legal exposure. Pending lawsuit. No material litigation identified. Legal risk can create unknown liabilities and distraction. Management. Owner-dependent. Full management team in place. Lower transition risk after closing. Reputation. Weak customer reviews. Strong customer satisfaction and repeat base. Reputation protects revenue quality. Now the question changes. Which company is really cheaper? The company priced at $5 million with more hidden risk, or the company priced at $6 million with stronger durability, assets, management, and reputation? Confidential and proprietary, Anpota Incorporated. Not legal, tax, accounting, investment, or financial advice. Anpota Incorporated proprietary acquisition research. Why numbers alone do not tell the full picture. The answer depends on the buyer, strategy, capital structure, and diligence findings. But the lesson is clear. The lowest purchase price does not automatically mean the best acquisition. 4. What financial statements often fail to reveal? A financial statement tells a buyer how the company recorded economic activity. It does not automatically tell the buyer whether the revenue is durable, whether the customers are loyal, whether the team can execute without the seller, or whether the balance sheet hides risk. The best buyers investigate the operating reality behind the numbers. They understand that EBITDA can be strong while the culture is broken. Revenue can be high while customer concentration is dangerous. Gross margin can look attractive while deferred maintenance is building. Cash flow can look strong while payables are stretched. Question what a spreadsheet may not show owner dependence, whether the seller is the chief salesperson, estimator, operator, customer relationship, and problem solver. Customer loyalty, whether customers are loyal to the company or only loyal to the founder. Management depth, whether there is a second layer of leadership able to operate after closing. Working capital, whether revenue is supported by collectible AR, healthy AP timing, deposits, WP, and normal cash conversion. Legal and compliance exposure, whether claims, liens, licensing, warranty issues, or litigation could impair the deal. Operational systems, whether there are repeatable processes, documented SOPs, reliable reporting, and job-level accountability. Reputation, whether the brand is trusted by customers, suppliers, employees, and the local market. A serious buyer does not ignore the financials. A serious buyer asks what the financials are not telling them. 5. The questions sophisticated buyers ask. Sophisticated buyers go far deeper than headline EBITDA. They ask whether earnings are recurring, transferable, supportable, and financeable. They want to know if the business can survive ownership transition, debt service, market volatility, hiring pressure, and growth. How durable is the EBITDA? How repeatable is the revenue? How dependent is the business on the owner? How concentrated are customers, suppliers, and employees? How clean are the financial statements and tax-to-book reconciliations? How much working capital is required to support the business? How much CapEx is required to maintain or grow operations? Confidential and proprietary, Anpota Incorporated. Not legal, tax, accounting, investment, or financial advice. Anpota Incorporated proprietary acquisition research. Why numbers alone do not tell the full picture. Are add-backs real, documented, and removable post-close? Can the company service acquisition debt after market compensation and reserves? Can the company scale without breaking operations? These questions move the buyer from simple valuation into real underwriting. The goal is not to find a perfect business. Perfect businesses rarely trade at attractive prices. The goal is to identify which risks are understood, which risks are fixable, which risks can be structured around, and which risks are fatal. 6. Different buyer types analyze the same deal differently. One of the most important acquisition lessons is that a business does not have one universal value. It may be worth different amounts to different buyers because each buyer brings a different cost of capital, operating capability, investment horizon, and strategic objective. Buyer type, primary lens, typical analysis. Individual buyer, income replacement, affordability, transition risk. Can I finance this, operate it, survive downside, and replace the seller? Private equity firm, platform potential and exit value. Can we scale EBITDA, add acquisitions, professionalize operations, and exit at a higher multiple? Family office, durability and capital preservation. Can this compound long-term cash flow with controlled downside and strong governance? Independent sponsor, financeability and investor narrative. Can we raise capital, secure debt, build a credible team, and execute the plan? Strategic buyer, synergy and integration value. Can this add customers, geography, licenses, capabilities, talent, or cost savings to our existing platform? This is why asking, what multiple is this business worth, is too simple. A better question is, what is this business worth to this specific buyer, under this specific strategy, with this specific risk profile? 7. How private equity firms think. Private equity firms are not only buying current EBITDA. They are buying the potential to grow, professionalize, and eventually exit a larger platform. They are often looking for a business that can become the foundation for something much bigger. A private equity buyer will typically evaluate platform potential, management depth, scalability, add-on acquisition opportunities, margin expansion, recurring revenue, systems, reporting, lender support, and exit multiple potential. For a private equity firm, the question is not simply, what is this company today? The question is, what can this company become with capital, systems, leadership, acquisitions, and execution? This is why a company with imperfect systems but strong demand may be interesting to institutional capital. The gap between what the company is and what it could become is where value creation lives. Confidential and proprietary, Anpota Incorporated. Not legal, tax, accounting, investment, or financial advice. Anpota Incorporated proprietary acquisition research. Why numbers alone do not tell the full picture. 8. How family offices think. Family offices often think differently from traditional private equity. Many are not trying to buy and sell within a short hold period. They may prioritize capital preservation, long-term cash flow, trust, governance, downside protection, and durability across cycles. A family office may ask whether the industry will remain relevant over the next decade. It may ask whether the business can protect capital, whether the management team is trustworthy, whether the company has strong assets, and whether the cash flow is stable enough for patient ownership. Where private equity may focus on multiple expansion and a 5-year exit, a family office may care more about long-term compounding, conservative leverage, and cultural fit. That is why founder legacy and governance quality can be very important to this buyer group. 9. How independent sponsors think. Independent sponsors must think like investors, operators, and capital raisers at the same time. They often do not have a fully committed fund behind them, so they must build the deal architecture and convince others to join. That means they need a complete story. Why this company? Why this industry? Why this seller? Why this purchase price? Why this capital structure? Why this operating plan? And why investors should trust the sponsor to lead the transaction. The strongest independent sponsors do not sell hype. They sell thoughtful underwriting. They present the risks clearly, explain the mitigants, provide a real diligence plan, and show how the business will be managed on Monday morning after closing. 10. How strategic buyers think. Strategic buyers often see value where financial buyers may not. A strategic buyer may already have operating infrastructure, customers, sales channels, management, systems, purchasing power, or geographic presence. Because of that, they may pay more than a financial buyer if the target creates synergy. For example, if a strategic buyer can eliminate duplicative overhead, add the target revenue to an existing platform, cross-sell customers, improve purchasing terms, and use current management to absorb the business, the same EBITDA may be worth more to that buyer. This is why individual buyers should study strategic buyer behavior. Even if you are not a strategic today, you can build strategic logic into your acquisition plan by showing how the business becomes more valuable through operational fit, vertical integration, or add-on acquisitions. 11. How individual buyers can gain an edge against larger funds. Confidential and proprietary Anpota Incorporated. Not legal, tax, accounting, investment, or financial advice. Anpota Incorporated proprietary acquisition research. Why numbers alone do not tell the full picture. Many individual buyers feel disadvantaged because they do not have the capital, team, or institutional brand of a private equity fund. That concern is understandable, but it is not the end of the story. Individual buyers can still win if they stop trying to play the exact same game as larger funds. Your edge may not be the highest price. Your edge may be seller trust, speed, flexibility, creativity, local commitment, operational involvement, or a stronger promise to preserve the seller's legacy. Many founder-owned businesses care deeply about employees, customers, community reputation, and what happens after closing. A larger fund may arrive with a polished deck and a higher offer. But an individual buyer can sit across from the seller and say, "I am not here to destroy what you built. I am here to protect it, professionalize it, and carry it forward." That can matter, especially when the seller wants a responsible successor. Practical ways an individual buyer can compete. Build seller trust early through thoughtful questions and real listening. Move quickly when appropriate, but do not skip diligence. Bring a real post-close operating plan, not just a financing idea. Build a small deal team with legal, accounting, lending, insurance, and operating support. Use creative structures such as seller notes, earnouts, rollover equity, consulting agreements, and working capital true-ups. Address risks directly instead of pretending they do not exist. Understand the seller's non-financial motivations, including legacy, employees, and community reputation. Individual buyers do not need to outspend every institution. They need to outprepare, outrelate, and outstructure the competition. 12. Quality of earnings is a reality check. Quality of earnings, or QoE, is not just a fancy accounting report. It is a reality check. It helps a buyer understand what earnings are real, recurring, supportable, financeable, and transferable. A seller may claim $2 million of EBITDA. After adjusting for owner compensation, personal expenses, one-time revenue, underreported costs, working capital issues, litigation, debt-like items, customer concentration, and market compensation, the real bankable EBITDA may be much lower. In other cases, messy books may hide a stronger core operation than the surface financials suggest. The point is not to attack the seller. The point is to understand the truth. Trust but verify. Respect the seller, but test the numbers. Be excited, but remain disciplined. QE focus area buyer objective revenue quality determine whether revenue is recurring, repeat, project-based, customer-concentrated, or one-time. Gross margin quality test whether margins are stable, sustainable, and properly matched to project costs. Confidential and proprietary, Anpota Incorporated. Not legal, tax, accounting, investment, or financial advice. Anpota Incorporated proprietary acquisition research. Why numbers alone do not tell the full picture. QE focus area buyer objective add-backs verify whether adjustments are documented, non-recurring, non-operating, and removable post-close. Working capital understand AR, AP, WP, deposits, deferred revenue, retainage, and required cash needs. Debt-like items identify obligations that should reduce purchase price or be paid off at closing. Management replacement adjust earnings for a realistic post-close leadership and compensation structure. 13. The story behind the numbers is where opportunity often lives. Some of the best acquisition opportunities do not look perfect at first. A business may have declining revenue because the owner stopped investing in sales. A business may have messy books but loyal customers and strong demand. A company may have weak margins because pricing has not been updated, purchasing is unmanaged, or job costing is underdeveloped. Average buyers see problems and walk away. Great buyers determine which problems are fixable and which problems are fatal. That distinction creates opportunity. Potentially fixable problem. Potentially fatal problem. Weak marketing or sales process. No real customer demand. Messy reporting, but strong bank deposits and customers. Financials that cannot be substantiated. No CRM or formal operating cadence. Culture that rejects accountability and leadership change. Underpriced services. Low-margin business model with no pricing power. No documented SPs. Key license, contract, or customer cannot transfer. Owner dependence with transition support available. Seller refuses transition and no team remains. The money is often made when you can tell the difference. Not every problem is an opportunity. Not every cheap deal is attractive. Judgment is the real edge. 14. Structure matters because price alone cannot solve every risk. When diligence reveals risk, the answer is not always to walk away and not always to accept the seller's price. Sometimes the answer is structure. Smart structuring can align incentives, protect downside, and give both buyer and seller a path to close. Seller notes, earnouts, rollover equity, performance payments, consulting agreements, escrow holdbacks, working capital true-ups, debt-free/cash-free adjustments, and retention bonuses can all be used to bridge gaps between buyer and seller expectations. The key is to match the structure to the risk. If revenue durability is uncertain, consider earnout mechanics. If owner transition is critical, consider a consulting agreement or seller rollover. If working capital is unclear, build a peg and true-up. If debt-like items exist, require payoff letters and lien releases. Confidential and proprietary, Anpota Incorporated. Not legal, tax, accounting, investment, or financial advice. Anpota Incorporated proprietary acquisition research. Why numbers alone do not tell the full picture. 15. A buyer framework. 10 dimensions beyond the numbers. Dimension core diligence. Question 1. Earnings durability. Are earnings recurring, repeatable, and transferable? 2. Owner dependence. Can the business perform without the seller? 3. Management depth. Is there a second layer of leadership? 4. Customer quality: are customers loyal, diversified, and profitable? 5. Reputation: does the market trust the company? 6. Systems and reporting: can the company be managed with reliable information? 7. Working capital: how much cash is required to support operations? 8. Legal and compliance: are there claims, liens, licenses, or litigation issues? 9. Growth capacity: can the company scale without breaking? 10. Structure and financing: can the deal support debt, investors, seller alignment, and downside protection? This framework does not replace financial modeling. It strengthens it. The more clearly a buyer understands these dimensions, the better they can underwrite risk, communicate with lenders, negotiate with sellers, and lead investors with confidence. 16. Final perspective: the real edge is judgment. At the highest level, acquisitions come down to judgment. Not just financial modeling. Judgment. Can you tell the difference between a cheap deal and a bad deal? Can you tell the difference between a premium price and a premium asset? Can you tell the difference between a fixable problem and a fatal flaw? That judgment is built through education, repetition, mentorship, diligence, seller conversations, lender conversations, operator insight, and the humility to keep learning. Numbers matter. But numbers alone do not tell you the full picture. A business is more than revenue and EBITDA. A business is people, process, reputation, customers, systems, assets, contracts, culture, risk, and future potential. Do not be the buyer who only sees the spreadsheet. Be the buyer who sees the full company. The best deal is not always the cheapest deal. The best deal is the one where the risk is understood, the value is real, the structure makes sense, and the future upside can actually be executed. That is how serious buyers win. Not by looking at numbers alone, but by learning how to see what the numbers do not show. Confidential and proprietary. Anpota Incorporated. Not legal, tax, accounting, investment, or financial advice. Anpota Incorporated. Proprietary acquisition research: why numbers alone do not tell the full picture. About Anpota Incorporated. Anpota Incorporated is focused on acquisition strategy, capital formation, private company diligence, and post-close value creation. This white paper reflects the firm's commitment to disciplined deal analysis, operational thinking, and buyer education. For acquisition entrepreneurs and investors, the message is simple: learn the numbers, but do not stop there. Build the judgment to understand the business behind the numbers. Prepared by Anpota Incorporated, proprietary acquisition research and buyer education. Confidentiality and disclaimer: this white paper is provided for educational and discussion purposes only. It does not constitute legal, tax, accounting, investment, financial, or valuation advice. Buyers and investors should consult their own advisors before pursuing or financing any acquisition. Confidential and proprietary. Anpota Incorporated. Not legal, tax, accounting, investment, or financial advice.